22, most people are broke. At 30, a small percentage of them are millionaires. Same 8 years, same economy, same 24 hours in a day. So what's different? It's not luck. It's not always inheritance. In most cases, it's 10 decisions repeated so many times they become identity. Today on Power Chronicles, we're breaking down 10 brutal, unfiltered rules of wealth building that quietly separate the people who get rich by 30 from the people still waiting for the right time. Stick around till the end. Rule number 9 is the one most broke people refuse to use, and it's the one that builds the fastest fortunes in modern finance. Let's get into it. Rule 1. Follow the money. Every industry has a money trail, and most people build their careers in the opposite direction of it. They chase passion without checking if the market pays for that passion. Here's the financial reality. In 2024, the average software engineer in the US earned around $120,000 a year, while the average nonprofit coordinator earned closer to $45,000. Both are valuable work. But if you're trying to hit millionaire status by 30, you need to be honest about which rivers have water in them. Following the money doesn't mean abandoning what you care about. It means positioning yourself inside industries with margin, tech, finance, specialized trades, e-commerce, high-ticket sales. Warren Buffett didn't get rich farming a niche nobody paid for. He went where capital already flowed and got better at moving it than anyone else in the room. Rule 2. Don't show off, show up. Here's a number that should scare you. Studies on lottery winners and high-income earners show that a huge percentage of people who suddenly get money lose most of it within 5 to 10 years, largely because of lifestyle inflation. The car, the watch, the vacations. They're financed by looking rich instead of becoming rich. Compare two people earning $80,000 a year. One leases a $60,000 car, spends $400 a month on their image. The other drives a used Honda, invests that same $1,200 a month into an index fund. Over 15 years, at an average 8% return, that's roughly $415,000, sitting in an account, while the other person has a depreciating asset worth maybe $8,000. Millionaires by 30 almost always look boring in their 20s. That's not a coincidence. That's the strategy. Rule 3. Save to invest. Don't save to save. A savings account paying you 0.5% interest while inflation runs at 3 to 4% a year is a slow bleed. You're not protecting your money. You're watching it lose purchasing power in a padded room. Here's the difference in real numbers. Someone who saves $500 a month in a regular savings account for 20 years ends up with roughly $120,000. Just the deposits plus almost nothing. Someone who invests that same $500 a month into a diversified portfolio averaging 8% annual returns ends up with approximately $294,000. In the same 20 years, same discipline, same $500, more than double the outcome, because one person treated saving as the finish line, and the other treated it as fuel for something bigger. Rule 4. Avoid debt that doesn't pay you. Not all debt is the enemy, but almost all consumer debt is. Credit card debt in the US currently carries average interest rates north of 20%. That means if you carry a $10,000 balance and only make minimum payments, you could pay back over $20,000 total before it's cleared, for purchases that were probably worth $10,000 the day you bought them. Compare that to a mortgage on a rental property at 6–7% interest, where the asset appreciates and someone else's rent payment covers the loan. One debt drains you every month, The other debt works a job for you while you sleep. The rule isn't never borrow. The rule is, does this debt buy something that pays you back or something that just disappears? Rule 5. Treat money like a lover. This one sounds strange until you unpack it. A lover you ignore, leave unattended, and never check in on. That relationship falls apart. Money is identical. People who build wealth check their net worth monthly. They know their spending categories. They know their interest rates, their portfolio balance, their credit score. People who stay broke often can't tell you within $10,000 what they're actually worth. Not because they're bad people, because they never built the habit of paying attention. Financially successful people don't necessarily earn dramatically more in their 20s. They simply track, adjust, and course correct faster because they're paying attention every single month. Rule 6. Money doesn't sleep. Markets trade nearly 24 hours somewhere in the world. Interest compounds on a Sunday exactly the same as it does on a Wednesday. Rent gets collected in your sleep if you own the property. Dividends get paid whether you refreshed your phone or not. This is the entire premise of passive income and compound growth. $10,000 invested at age 22 at an 8% average return becomes roughly $46,000 by age 42 without adding another dollar. Wait until 32 to start that same $10,000, and by 42 you'd have closer to $21,500. Same amount invested. Same return rate. A single decade of delay costs you more than half the outcome. Money doesn't sleep, but it definitely punishes you for sleeping on it. Rule 7. Poor makes no sense. Change your mentality. This isn't about denying real financial hardship. Structural barriers are real. But research in behavioral finance consistently shows that scarcity mindset changes decision-making. People who believe money is scarce make shorter-term decisions, avoid calculated risks, and often underinvest even when they technically have the ability to. The mental shift that tends to precede financial growth is simple. Stop asking, "Can I afford this?" and start asking, "How do I afford this?" One question shuts down your brain. The other one activates it. Toward a side hustle, a skill upgrade, a negotiation, a new stream of income. Rule 8. Get a millionaire mentor. You cannot Google your way to instincts that took someone else 20 years of trial and error to build. A good mentor doesn't just give you information, they give you pattern recognition. They've already made the $50,000 mistake you're about to make, and they can help you skip it entirely. This doesn't require knowing a literal millionaire personally. Books, podcasts, mastermind groups, even structured online courses from credible operators. These are all mentorship at scale. The real cost of not having one isn't zero. It's every expensive mistake you make alone that a 5-minute conversation could have prevented. Rule 9. And this is the big one. Get your money to do the heavy lifting. This is leverage. Leverage means using borrowed capital, other people's time or systems to multiply your output beyond what your own two hands can do. A real estate investor who puts $50,000 down on a $250,000 property is using the bank's $200,000 to control an asset 5 times the size of their own cash. If that property appreciates just 5% in a year, that's a $12,500 gain, a 25% return on their actual $50,000, not 5%. Business owners do the same thing with people. One person can only work so many hours, but 10 employees generating value multiply that person's earning ceiling by 10. This is exactly why business owners and investors dominate wealth statistics compared to even high-earning employees. A surgeon trading hours for dollars caps out eventually. An investor with leveraged assets, in theory, doesn't. Leverage is a tool, not a shortcut. Used carelessly, it multiplies losses exactly as fast as gains. But used with discipline, it's the single fastest path from saving money to building wealth. Rule 10. Aim 10 times higher than your current goal. If your target is $100,000, aim for 1,000,000, not because you'll necessarily hit it on schedule, but because the strategy required for 100K and the strategy required for one Nebtutras are completely different games. One is a savings problem. The other is a leverage, ownership, and scaling problem. Aiming 10 times higher forces you out of small thinking and into asset-building thinking, automatically, because the smaller version of the plan simply won't get you there. 10 rules, 0 luck required. Every one of them is a decision you can start making this week, not at 40, not when things calm down, but right now, with whatever amount of money you currently have. Wealth by 30 was never really about the number. It's about which of these 10 decisions you're willing to make before everyone else is ready to. If this hit different, hit subscribe. Power Chronicles breaks down the real financial mechanics behind wealth, power, and influence every single week. Drop a comment. Which rule are you starting with today?